Welcome to the Explainer. So, if you've ever wondered how massive multinational corporations actually manage to transition from their old hyperlocal accounting rules to a single globally recognized standard without the whole operation completely falling apart, well, you're in exactly the right place. Today, we're unpacking the ultimate translation dictionary for corporate accounting, IFRS 1. Just imagine a sprawling conglomerate with operations in 20 different countries suddenly trying to speak one unified financial language. I mean, it's an astronomical task, right?
Really think about it for a second. How do you rewrite your company's entire financial history without completely breaking the bank? Transitioning to a new accounting language is a massive, incredibly complex, and, let's be honest, potentially very expensive headache. Audit fees can absolutely skyrocket. Entire IT systems need massive overhauls. You're dealing with years, sometimes decades, of past transactions recorded under one very specific set of local rules, and suddenly they need to make perfect sense under a completely different global framework. The sheer panic this can cause in an accounting department is very real. But that's where IFRS 1 steps in. It pragmatically solves this exact problem, creating a desperately needed bridge from the old world to the new.
Okay, let's just quickly run through the roadmap for today's explainer. We'll start with a quick welcome to IFRS 1, cover the scope of when to actually apply it, look at the opening balance sheet, tackle exceptions versus exemptions, and finally wrap up with explaining the transition.
Welcome to IFRS 1, the ultimate translation guide.
You can kind of think of this standard as a trusty mentor. Its whole purpose is to hold a company's hand and guide it safely from the old world of its previous GAAP into the new, highly comparable global language of IFRS. The International Accounting Standards Board explicitly states that the goal here is to generate transparent information but, and this is a massive but, at a cost that does not exceed the benefits. Imagine forcing a company to perfectly recreate 50 years of historical ledger entries just to adopt a new standard. No way. That would practically bankrupt them. This document is specifically designed to prevent that exact nightmare, facilitating transparency without literally crushing the accounting team.
Moving right along to Section 2, Scope, or exactly when to apply this one-time key.
So this standard isn't something you pull out every single year. It strictly applies to the very first annual financial statements that contain an explicit and unreserved statement of compliance with IFRS. There is absolutely no halfway here. You can't adopt it with caveats or little asterisks buried down in the footnotes. If you're adopting these standards, you've got to loudly and proudly declare it without any reservations. That exact, unreserved declaration is exactly what unlocks the rules we're talking about today.
The source material gives us some highly specific scenarios that trigger a first-time adoption. For instance, maybe you presented your most recent statements under national requirements that just weren't fully consistent with IFRS. Or, interestingly, maybe you actually prepared IFRS statements for internal management use behind closed doors, but you never showed them to external owners. Doesn't matter. Even if you've practiced with IFRS internally for years, the absolute second you make your official public debut with that unreserved statement of compliance, you must use IFRS 1 to cross the finish line.
All right, Section 3, the opening balance sheet. This is all about laying the foundation.
To lay the foundation of our new financial house, paragraph 10 breaks down the chronological process of preparing your opening balance sheet into 4 highly digestible steps. First up, you've got to recognize all assets and liabilities that IFRS actually requires. Second, you must aggressively de-recognize, so remove items that IFRS does not permit you to count. Like maybe your old rules let you recognize certain early-stage research costs as assets. If IFRS says no, you've got to completely de-recognize them right here in Step 2. Third, you reclassify items. Maybe something treated as equity under your old rules actually meets the strict definition of a liability under IFRS. And fourth, you measure all these recognized items strictly applying IFRS rules, the whole shebang.
Taking a look at the Entity A example from the source material really shows how this builds because the timeline here is absolutely crucial. Say your first IFRS reporting period ends in December 20X5. Well, you are completely locked into the standards effective on that exact date. You must use those specific 20X5 rules and apply them backwards to prepare your opening balance sheet all the way back on January 20X4. You are absolutely not allowed to cherry-pick older, easier, or outdated versions of standards just because they were effective at earlier dates. You have to use the most current rulebook at the end of your first reporting period and apply it consistently across all the comparative periods you're presenting.
Section 4, Exceptions versus Exemptions. The strict rules versus the handy shortcuts.
Now, this right here is probably the most vital conceptual contrast in the entire standard. Exceptions are the strict, mandatory rules handed down from the inspector. They're absolute prohibitions against applying standards retrospectively, and you literally have no choice but to follow them. Exemptions, on the other hand, well, those are your lifeline. They're a totally voluntary menu of choices granted by the board to save your sanity and your budget from the heavy burden of perfectly recreating ancient corporate history.
Let's look at a mandatory exception first: accounting estimates. The standard strictly prohibits using hindsight. It's effectively preventing accounting time travel. For example, if your transition date is January 1st, and then on July 15th you get some brand new information about an estimate you made back in December under your old GAAP, well, the exception prohibits you from using that new July information to rewrite history on your opening balance sheet. You cannot use tomorrow's news to fix yesterday's estimates. You've got to stick with the conditions that existed exactly at the transition date.
Beyond estimates, Appendix B lists a few other highly technical areas, things like the derecognition of financial assets, hedge accounting, non-controlling interests, and embedded derivatives. In these specific areas, the math and the historical logic are just way too complex to reverse engineer fairly. The board totally recognizes this, so they mandate prospective application. Basically, they're saying, do not look back. Just apply the new rules moving forward from the date of transition.
Now, transitioning over to the voluntary side, one of the absolutely most powerful exemptions is the concept of deemed cost. Imagine trying to dig through dusty filing cabinets to find the original construction invoices and literally decades of depreciation receipts for a factory your company built 40 years ago. It would be a complete nightmare. The deemed cost exemption allows an entity to measure an item of property, plant, and equipment at its fair value right at the date of transition and simply use that fair value as its new cost going forward. It's a massive, practical time saver that stops accountants from chasing ghosts in the archives.
And honestly, deemed cost is just the beginning. Appendices C through E provide extensive optional exemptions. You can elect not to retrospectively apply IFRS 3 to past business combinations. There are handy exemptions for how you handle older share-based payments, leases, and cumulative translation differences for foreign operations. The board recognizes that perfectly unscrambling the egg of past corporate acquisitions or decades-old, highly complex leases is practically impossible, so they offer these pragmatic shortcuts to just keep the transition moving forward.
Finally, Section 5, explaining the transition, which is all about guiding your external users.
So, you've done all the hard work of translating the numbers internally, but now you've got to prove your work to the outside world. That's exactly why comparative information is absolutely vital here. Under IFRS 1, your first financial statements must include at least 3 statements of financial position. You need the end of the current year, the end of the prior comparative year, and that all-important opening balance sheet right at the date of transition. This gives investors the exact historical context they need to actually trust the shift and see how the numbers evolved over time.
To make that happen, paragraph 24 mandates that you build a crystal-clear mathematical bridge for your investors using detailed reconciliations. They need a precise map connecting the equity you reported under your old previous GAAP directly to your new equity under IFRS. And you've got to do the exact same thing for your total comprehensive income. External users need to be able to trace the lines and see exactly which specific adjustments caused profit or equity to fluctuate during the transition. Like I always say, it's all about showing your math.
But here's the catch. When you dig through years of past accounting records with the magnifying glass of a brand new global standard, you are almost guaranteed to find some skeletons in the closet. If this rigorous reconciliation process uncovers past mistakes made under your old accounting rules, the standard demands absolute transparency. You must clearly distinguish the correction of those previous errors from the standard adjustments caused merely by changing your accounting policies to IFRS.
All right, we've covered the strict scope, the mandatory exceptions, the pragmatic exemptions, and the comprehensive disclosures required by IFRS 1. It's a brilliantly structured toolkit designed to safely bring companies into a comparable global financial ecosystem. So I'll leave you with this one final thought. Now that you have the blueprint to translate your financial history, how will this new global language completely change the way the market values your business? Thanks for joining me on this explainer, and keep exploring the incredible mechanics behind the numbers.